Ladies and gentlemen, the Federal Reserve just cut the interest rate by 0.5%, and that's an incredible surprise. So the whole stock market should be reacting to it very positively, right? No, not really, right? So let's see what the reactions are, and more importantly, what Mr. Lu will predict moving forward. So watch until the end. So the Federal Reserve Open Market Committee yesterday made an announcement that they will cut the interest rate by 0.5%. And that's a very surprising thing to me, although half the market actually predicting that already, and the other half say 0.25%. That's a big surprise to at least half the market. Then why is the whole stock market beginning to decline? So let's watch on, shall we? As usual, these are my usual disclaimers, and let's go. Jerome Powell and his Federal Reserve Open Market Committee all met for 2 days, and they did two important things. Number one is they make a decision to reduce the federal funds rate by 0.5%, 50 basis point. That's the first decision. The second thing they did was they actually made a prediction of what they think will be the interest rate moving forward. We call that the SEP, right? Summary of Economic Projection. And I'll talk about it later in the talk. The most important thing is, how did the market react to this surprise? Well, unfortunately, the market was very turbulent yesterday and it ended up lower. So if you see, initially the stock market went up, S&P 500 went up, and then when it closed, went down. Same for the NASDAQ, and even the TLT, which is the bonds, okay, also went down, close slightly lower than it was. So that's a quite a surprise to the entire stock market, and quite a few people asked me, Mr. Lu, why, right? I thought you say, interest rate cut, everything should go up, that kind of thing. So in order to understand the entire market, let's see what Jerome Powell says first, shall we? Jerome Powell made a few very important statements. The first statement that he made was the US economy is strong and the labor market has cooled down. He don't see any risk of a recession in the US economy. Although there are people who say that, if you don't see any risk, why you cut by 0.5%? But we'll talk about that. The key thing is inflation has substantially eased from the peak of 7% to an estimated 2.2% right now in August. They have a dual mandate of maintaining maximum employment and low inflation, and this is right now becoming very important to have a balance between the two. Clearly, specifically, there is a lower risk of reinflation right now. He don't think that inflation will reignite again, but there is a higher risk of increasing unemployment. They want to react right now before the balance go out back to the other direction that they cause unemployment. Then the question, why they cut 0.5%, not 0.25%? Well, they have basically gained a lot of confidence that inflation is now moving in the right direction, and the labor market is a lot less tight than before the pandemic. I'll quote him, the labor market is actually in a solid condition, and our intention with our policy move today is to keep it there. But the choice to move big at the start of the easing cycle shows that the Federal Reserve is willing to take stronger action if the labor market deteriorates further, says one of the economists. Basically, they are very confident inflation is going down, and keeping low. So with that, they can be more forceful in having an interest rate cut. So I think that's good, essentially, for all the financial markets. So even I was surprised by it, right? Now, because traditionally, 0.5% cut are being instituted when there is a bad economic environment like 2000 financial crisis or COVID or something like that, right? So 0.5% in a normal time like this, seems like a big surprise. So I lost a bet to my friend Mark, who is adamant that there'll be a 0.5% cut. I was so confident then that I actually lost a bet, right? So because I lost a bet, I have to help him relay a message to his wife online to everybody that Mark loves his wife, Jeline, tremendously, right? Very, very much, right? So this is a very important message that I have to deliver for him because I lost the bet. Jokes aside, 0.25% out the window. But I think most importantly is that, this is a very nice surprise. More importantly, the Federal Reserve Open Market Committee predicted what the interest rate would be for the rest of 2024, 25, and 26. And these are what we call a summary of economic projection. So the Federal Reserve did a dot plot, right? So get everybody to do a independent plot and see where the interest rate is going, and this is the average. So by this year, they predict that there will be will end at 4.4%, which means that there could be another 0.5% cut or two 0.25% cut. And in 2025, you'll go down to 3.4%, and 2026 to 2.9%. This is where the projection is. For those people who are doing refinancing for your homes and things like that, just take note that interest rate trajectory is coming down and down and down. So as I said, the key is to focus on 2024 because we do expect another 0.5% cut. And some of the analysts are already being bullish and say that you'll be even 0.75% cut. And there are 2 more meetings in November and December. Let's see how it goes. But certainly, interest rate cuts are generally good news for the stock market and for the bonds market. So what are the implications for all of us who are invested in the financial markets? The stock market and the bonds market have went down because, in my opinion, all these cuts are more or less factored already. Stock market usually sell on good news, and that's a very common phenomenon. For those people who are very upset over yesterday's results, don't worry, okay? Generally, we are seeing a projection that is going to go for both markets, and we just got to be a bit patient. So this is my prediction. Soon, okay, in the short term, we were likely to see an adjustment moving up in both markets, be it the bonds market or the stock market. But this is not just good news for the stock market and bonds market. This is also good news for property, for cars, for REITs. Maybe slightly bad for the banks. The banks would then collect less revenue for the interest rates. And this is not something that is good news for the banks, but our banks are quite well diversified. So this one is unlikely to hit our banks in a hard way. Generally speaking, it's good news for most borrowers, and for lenders, it's generally bad. This is a very important news. We have been waiting for 2 years, since 2022, for this to happen. This is a very important milestone of the modern financial times that we are in right now, that we have decisively defeated inflation. It doesn't mean that prices have gone down, but the rate of increase have gone down tremendously to a comfortable level, and it's probably good times moving forward. Generally speaking, of course, the market will be hit with unexpected news and storms and things like that. So volatility we expect it there. But I would say that the trajectory, right, will be a curve that's moving up with a lot of volatility in between. So for those people who have waited patiently for long enough, congratulations. The markets are now in your favor. Okay, continue to yield the fruits and be happy. For those people who haven't, just learn from this experience, and when the next time it comes, just be aware and react accordingly. Okay, thank you for watching, and I'll see you in a day or two. Bye-bye. So this is Mr. Lu again. I didn't realize after I finished the video that the whole stock market is now rallying on the futures market. The S&P 500 is registering a 1.6, 1.7%, positive, and is set to break an all-time high again. So I just want to say that it looks very promising. Let's see what happens tonight, shall we? Okay. I think it's all good days moving ahead. See you. Bye bye.